On a Monday morning, you open your investment app just to make sure everything looks fine before starting another workday. Overnight, your portfolio is down 4%, and even though nothing has disappeared, your chest suddenly feels a little tighter. Strangely, your portfolio gained a little almost every day last week, yet those good days barely stay in your memory. One red day seems to erase the feeling of 10 green days, almost as if your brain remembers pain more easily than progress. You may start wondering whether selling now could prevent a bigger drawdown, even though that question often feels completely reasonable in the moment. Millions of investors experience the same reaction because the human brain was never designed for modern market volatility. Welcome to the margin, where finance is explored through both numbers and the way our minds respond when money is at risk. Today we'll explore why one bad day feels stronger than 10 good ones, how that bias quietly affects long-term decisions, and a simple framework for thinking more calmly. We often think investing is a game of numbers, but in everyday life it becomes a game of emotions far more often than we realize. A small gain barely interrupts most people's day, but an equally small loss can quietly change how the entire day feels. Psychology gives this reaction a name: loss aversion, where losing feels much more painful than gaining the same amount feels rewarding. Behavioral finance research suggests that losing $100 often feels about twice as painful as gaining the same amount feels satisfying. The market does not need a deep drawdown to disturb us because even a modest decline can reshape how we picture the future. This reaction is not about personal weakness because our brains still rely on survival systems built thousands of years ago. For our ancestors, losing food or resources threatened survival. So evolution trained the brain to notice losses much more than gains. Today, that same survival mechanism often treats a red market screen as if it were immediate danger that must be escaped. In reality, the market is not chasing anyone because prices are simply doing what markets have always done, moving. The more we recognize that fear is a biological response, the easier it becomes to separate that feeling from the simple movement of prices. Now imagine two investors who both experience a $500 portfolio drawdown in a single day. Yet the decisions they make lead them toward very different futures. The first investor panics and sells every investment because ending the emotional pain feels more urgent than staying invested. The second investor feels the same fear, but he does not let that fear immediately control his next action. Weeks later, the market begins recovering, and months after that, prices move above where they stood before the decline. The first investor avoids a little more downside, but also misses the entire recovery that follows afterward. The second investor continues living with temporary discomfort, and his long-term position remains part of the market's gradual growth. This is what this video calls the $10,000 aeronaut, the loss from market volatility, but the larger gains that disappear because emotions peak first. The mistake rarely feels expensive on the day you sell because its real impact usually appears years later. People often focus on protecting $500 today without noticing they may be giving up tens of thousands over a much longer time horizon. The real question is no longer whether another red day will arrive, but who is actually making your decision when it does, your investment strategy or your own fear. In March 2020, the U.S. stock market experienced one of the fastest drawdowns in modern history within just a few weeks. Millions of investors kept opening their investment apps throughout the day, not to buy, but to see whether things had become even worse. Many people eventually pressed the sell button because in that moment it seemed like the most reasonable decision. Emotionally, selling brought temporary relief because it felt like their money had finally been protected. A few months later, the market recovered faster than many expected, leaving those who had sold watching the rebound from the sidelines. Research suggests that one of the biggest investing mistakes is missing the market's best recovery days after exiting during peak volatility. The market never announces when its strongest recovery days will arrive, and they often appear soon after the worst ones. Selling after a single red day may not only avoid further losses but also increase the distance from the next opportunity. The largest investing cost is often not taxes or transaction fees, but an emotional decision that felt reasonable at the time. The market eventually recovered, but not every investor recovered with it because some had already left the game. We often assume that panic selling only happens to beginner investors, yet experience alone does not make anyone immune to fear during market volatility. Doctors, engineers, business owners, and even finance professionals can still make poor decisions when emotion moves faster than logic. The problem is not a lack of knowledge because the human brain naturally reacts before it has enough time to think. Imagine someone who has invested for 5 years, watching steady long-term growth while trusting the original strategy. Then one morning, a sharp overnight drawdown suddenly overwhelms years of confidence within only a few seconds. At that moment, many people stop searching for facts and begin searching for headlines that justify selling. Psychology calls this confirmation bias because fear naturally pushes us toward information that strengthens the same fear. The more negative news we consume, the more it feels like everything is collapsing even when only our mood has changed. Successful investors are not people who never feel fear, because they simply recognize that emotions are not always reliable information. In financial markets, feelings often arrive before reality, leaving emotions ready to take control long before the facts appear. So, how do you deal with a bias that is already wired into the human brain without trying to remove the fear itself? At the margin, we call this framework the Emotional Equalizer because it is designed to restore balance when market volatility begins to affect emotions. The first step is to zoom out by looking beyond a single day and focusing on a much longer time horizon. A drawdown that feels overwhelming today often becomes a tiny detail when viewed across many years. The second step is to reframe red because lower prices can represent a different context than immediate loss. Experienced investors often buy during fearful markets because prices and public emotions do not always move together. The third step is the 24-hour rule by avoiding selling decisions while panic is still at its highest point. After a full day, the market may look the same even though your perspective no longer does. The final step is returning to the original reason you chose the asset instead of focusing only on today's emotions. This framework does not change market volatility, but it changes when important financial decisions are made. Many people believe successful investors always know the perfect time to buy and sell, but most simply stay calm while everyone else begins to panic. Green days and red days are not unusual events because market volatility is simply part of the price paid for long-term growth. The more often we try to escape every small drawdown, the greater the chance of missing much larger long-term gains. Investing is not a race to avoid every loss, but a long process where fear can quietly change the direction of the journey. Many people believe successful investors always know the perfect time to buy and sell, but most simply stay calm while everyone else begins to panic. Green days and red days are not unusual events because market volatility is simply part of the price paid for long-term growth. The more often we try to escape every small drawdown, the greater the chance of missing much larger long-term gains. No investor can control where markets move, but every investor experiences their own response to those movements. A quieter form of financial freedom is having enough calm that every small market movement does not demand an immediate reaction. In the end, portfolios that keep growing are often owned by people who remain patient rather than constantly busy reacting. Every time the market drops, we begin telling ourselves a different story, quietly wondering if this time the risk is somehow different and everything could become much worse. In many cases, what changes is not reality itself, but the narrative that fear keeps replaying inside our minds during volatility. The human brain is remarkably good at imagining worst-case scenarios, even though it is far less accurate at judging how often they actually happen over time. That is why experienced investors build more than a portfolio, because they also develop the discipline to question their own thinking. When fear appears, they do not immediately act, instead asking whether what they feel comes from facts or from their own emotional reaction. That single question can often protect more money over a long-term time horizon than any technical indicator alone. As your assets grow, managing emotions gradually becomes more important than trying to predict every move in the market. Large gains rarely come from one brilliant decision, but from countless small choices that are not interrupted by panic during drawdowns. Building wealth often feels difficult not because the math is complicated, but because our instincts keep pulling us in another direction. Perhaps the biggest challenge for an investor is not confronting the market itself, but facing the thoughts inside their own mind. Red days will always come, just as green days eventually return after every period of market volatility. Your financial future is shaped less by changing markets and more by how often emotions change your long-term plan. Remember the emotional equalizer. Zoom out, reframe the red 24-hour rule, and return to the plan. Long-term gains do not require the absence of fear, only the ability to keep thinking clearly while fear is present. If this video changed your perspective even slightly, you may find more discussions about money psychology, investing, and modern financial life on the margin. Sometimes the missing piece is not a more complicated strategy, but a calmer way of looking at financial decisions. When was your biggest panic selling moment, and what was the most valuable lesson you took from that experience? Thank you for watching, and tell us in the comments whether you would make the same decision if you could return to that panic selling moment.